Okay, we have a leadership team here at the EPI West Michigan chapter, certainly myself, Randy Rua, Tamara Sisma, Mark Davis, Paul Zielinski, and Chip Talon. So you can kind of see their pictures and where they're from. And what we're trying to do again is just to bring in really good content and speakers to help educate everyone on this very, very important topic. So next slide. So without any additional hesitation, I know what you all came for. So I'm just going to introduce John Pollock, who is the Managing Director at LV2 Equity Partners. I've had the pleasure of knowing John for a short period of time within the last year and had some opportunity to chat with him. And I think the topic that he's going to be talking about today is very, very important, not only as advisors, but any business owners that may be listening as to what needs to be looked at when you're looking at making a transaction. John is going to be talking about this from a normal markets perspective at first, and then at the end of his discussion, he is going to be talking to how the environment will probably enhance change since COVID-19. So without any further hesitation, I'll just let John go ahead and take over. John, I'll let you have the steering wheel. If anybody wants to ask a question, there's a chat box on the side. Go ahead and submit your questions in there. We'll make sure that we get them asked. So, John?
Great. Well, thank you, Vince, and thank you, everybody, for attending this morning. I hope I can share some valuable tidbits on this topic with the time we've got together this morning. Before we get into the presentation, I think I want to throw out maybe a couple disclaimers, for lack of a better term. When Vince approached me, it was maybe 5 or 6 months ago about this possible topic. So when we put this presentation together, it was premised on normal times, however you would define that. And considering the environment we're in right now, everything kind of takes a back seat to what we're contending with. So the bulk of this presentation is, based on a normal environment. I'm happy to get into any of COVID-related things at the end, take any questions you might have, but the bulk of this presentation is more general than that. I've also put it together in very broad strokes. Like anything, private equity is kind of a very complex topic and very broad, so I've taken a very broad approach to it. Every situation, as you know, is situational, so I'm happy to delve into any particular situation deeper as the audience, may want to do that. But the presentation in of itself is pretty broad. So before we get going, I think, Lisa, you had another polling question that we'd start off with.
I do. Can everyone see it? What would best describe your perception of private equity? I know you can't see this right now, John, but as soon as we have the majority of the people voting, I will share it so we all can see the results.
Okay.
How many we got, Lisa?
Looks like we have 90%, so I'm going to go ahead and end it at this point and share it. And here are the results.
That's pretty good, I think.
Mm-hmm.
I want to talk to the 3%. I figured we'd get a couple of those. Great, thank you.
You're welcome.
So I guess what I'd like to start this presentation off with, considering the audience, as primarily business owners that are looking to sell or beginning the planning process of selling, as well as the service providers that assist them in that. I thought I'd start with just, I guess, general advice I, as a private equity buyer, would give to any of those parties. And then we'll dig down deeper into each of those through the rest of the presentation. But the first thing I would say is make sure and understand the different types of private equity groups that are out there and where the one you're dealing with falls in the array. Because they all have different nuances and will operate slightly different ways. So it's critically important to understand who you're dealing with. Secondly, while the types of PE firms can be quite different, the goals are generally the same. They may execute a little differently, but the overall goals of the PE buyer are generally the same, and we'll get into that a little later also. You want to understand the factors they're going to focus on when looking at valuing your business, and a lot of that is going to kind of be around due diligence, and we'll dig into that a little bit later also. As it comes to due diligence, I would caution everybody to be prepared for pretty intense scrutiny during the due diligence process, and don't take it personally. It is a fact-finding mission. It's not a personal affront in any way, but it can often come off that way to the business owner sometimes. Also, I think it's really critical to understand how the PE group sees your business fitting into their fund or family of business. In other words, are they viewing this acquisition as a standalone platform that they'll use as a foundation to grow? Or are they viewing your business as an add-on to something they might already have, a complementary piece? Because how they're going to approach things and how they'll value things are going to vary greatly depending on how they're viewing that. So that's an important thing to understand up front. Also, depending on the situation, it's critically important to understand, does this buyer want or need your involvement post-close? I think many business owners often think of the sale of their business as, retirement, and that certainly is true. But when selling to a private equity player, or many other buyers for that matter, at a minimum, you can expect a transition period where you're still going to have to be very actively involved. And depending on what the PE buyer is seeking in your company, they may want or require much more involvement, up to and possibly including you running the business for some extended period of time, you potentially providing seller financing, you potentially rolling over equity. So it could vary based on an array of circumstances. And those are really important things to understand early in the process. And the last two, I can't emphasize enough the importance of engaging an M&A advisor well before you go to market. Not only to help you through the sale process, but to help you do your own, I call it sell-side due diligence before you go to market. You want your company looking and acting absolutely positive as possible. So I would strongly encourage that to be the case. I'm always amazed by the amount of small business owners who often attempt to take their company to market by themselves. And that is a really tough thing to do for a number of reasons. So with that, next slide, please. Let's start with just an overview of, the types of private equity groups that are out there. And I chuckle, private equity is such a broad term. It gets bantered around a lot. It's incredibly broad. But I think for our audience, when you're looking to sell to a PE buyer, you're generally going to fall into one of three categories. Either the committed fund equity sponsor, the independent equity sponsor, or a family office. Now, there are other types of PE buyers out there. There are hedge funds, venture capital firms, angel investors, and kind of unitranche lenders who do the whole right side of the balance sheet. So they may provide equity and debt, and they're all different parts of the PE world, but I think these, for purpose of our conversation, these are the three you're most likely to see.
John, could you spend a couple minutes to kind of go through what's the difference between them?
That's our next slide.
Oh, okay, super. Thank you. Jump the gun.
Let's talk about the committed fund equity sponsor first. And these are the big ones. These are the ones that get the vast majority of the press. These are the traditional private equity groups, the KKRs, Carlyles, Blackstones of the world. And what differentiates them from the other players primarily is two things. One's their size, and second is how they raise their capital. So a committed fund, by nature of the term committed fund, what these equity sponsors have done, and they've went out and raised capital primarily institutionally. So they're going to players like insurance companies, pension funds, endowments, as well as very high net worth accredited investors and family offices. And they're raising a committed fund up front. You know, it could be $500 million. And so they've raised that money up front to go out and make a number of acquisitions. Due to their size and assets under management, they're often regulated by the SEC in certain ways, so they have a significant amount of infrastructure in place to contend with that. Structurally, they utilize the general partner, limited partner structure and the 220 economics model. So you might hear those terms bannered around, but GP or general partner is the private equity group. They're the owner that controls the decision-making process for the most part. The limited partners are the investors who are typically involved there in a passive way. The economic structure of these funds tend to be 220. The two being when you raise a fund, they're typically taking 2% off the top to get that fund up and going, particularly if it's their first fund. So it funds startup costs, it funds staffing up, building out teams, finding operating partners. And then the 20 is really where private equity generates, if they do things right, generates the majority of their net worth and return. And 20 refers to a 20% carried interest in that fund, which for all intents and purpose means profit sharing. So after the investors are returned their original investment, usually some preferred return, at 20% profit sharing kicks in on the rest. And that is ultimately what private equity groups are looking to achieve, growing enterprise value and recognizing value in that 20% carried interest. Each of these funds, generally speaking, have a finite life to them. So when they raise money, it's typically, the fund is typically set to be in existence for something like 10 years. So the clock starts ticking. You have 10 years or so to use that money, go out and find opportunities, buy businesses, enhance and grow them, and ultimately harvest or sell them. And it's generally over the life of the fund. So you're typically looking at a 10-year life. Now that oftentimes gets extended, but that's the general setup of it. So what that drives are PE groups that can move very fast, they want to invest large buckets of dollars quickly, because if they don't, they're going to likely lose that funding mechanism. So these groups have significant deal origination teams in place. They have deep bench of operational partners that they might plug into the companies they acquire. They could be very broad and agnostic in their investment approach, or they could be very niche and specific. It could vary. They're almost always control investors, don't usually make minority investments, but some do. And the interesting thing from an investor standpoint is if you invest in a fund, you're along for the ride of that fund. So you don't get to pick and choose the businesses that are getting acquired. You're in for the whole bunch per se. And because of the size and scope and the finite period, these groups, you know, their model, this is very general, but their model is premised on more board oversight and governance and strategic interaction with the portfolio companies versus being very operationally involved at the company level, because that allows them to expand their bandwidth and invest more dollars. So that's the committed fund sponsor. Next slide, please. Second category would be an independent equity sponsor. And this is where, again, another broad category. And this is actually where my firm falls. LV2 is considered an independent equity sponsor. And the primary difference between this and the committed fund is exactly that. Independent sponsors haven't raised the committed fund. They instead fundraise individually per deal for the most part. So they'll find a business to buy, typically get it under letter of intent, and then simultaneously with everything else, go out and raise the equity. They may have investors sitting alongside, but it's not committed. It's more of a pledge arrangement. So they'll go to their investor base and say, hey, we found this business. We're going to buy it for X. This is what it looks like. Are you interested in investing? And that's generally how the independent equity sponsor operates. They're not raising money institutionally, typically. They're going to accredited individuals and often family offices to raise the bulk of their equity. Another differentiation here is, for the most part, investors in these vehicles get to look at each deal individually. So they get a fully vetted individual acquisition to look at up front and decide whether they want to participate. These entities tend to be smaller, so they're often not regulated by the SEC in any way. That allows them to be smaller, a little more flexible in their approach. They vary greatly in size and areas of expertise. And it's interesting to look at the independent sponsor world. When we started 12 years ago, there were not a lot of them around, and now they're all over the place. It's grown exponentially, and they really vary in their size and experience. Some simply put deals together. So they raise money, put deals together for a fee and carried interest, and have very little involvement in the business. It just runs the gamut. That's why it's important to understand the group you're working with and how they're going to operate. Since these have more flexibility, they often make minority plays. They're typically control investors, but they will do minority plays periodically. And again, their way of operating could be much broader than the committed fund. They may take the very macro approach of being board oversight strategic, or they may roll their sleeves up and get incredibly involved in the operations of the business. It depends what their value proposition is. And the other thing that I would caution with these types of funds is, closing risk does exist here by nature of they don't have committed funds sitting there. Now, like in our case, we've never not raised the money. We've always been oversubscribed. And I would contend most independent sponsors are that way. But I think if you're dealing with one, it's important to understand their track record. So that's the independent equity sponsor. Next slide. Family office is a fascinating group that has, again, they've always been around, but over the last decade have really, would say, come out into the public sphere more. The primary difference here is they don't need to raise money from investors. Their capital source is primarily their family net worth. So no fundraising required. They're not regulated. And because it is effectively their own money, their investment horizon can be much longer. They have great flexibility and structure. And their end goal may be a little different in that they first, rather than solely focusing on return over time to investors, one of their goals or priorities may be growth and diversification of the family net worth, or generating a future income stream for family. It could be an array of different things, but they bring a really interesting twist to the private equity world. And for an individual owner operator, I think they may look at the family office and say, I really like the way they do things because they operate really the way we do. Legacy matters. There's often immense amounts of family involved. So there's a connection there that could make sense. That's a family office. Next slide. Yeah, common goals. So while the players may be a little different, the goals are generally consistent. And the primary one being private equity groups are in business to generate a return on investment for their investor base and for themselves. And based on how they're set up and structured and what they're looking to do, that return could vary from 15 to 30% might be their target IRR. It could vary based on an array of factors. There's also a period of time that they want to recognize this return in. And if you have a finite life fund, like we spoke about earlier, you're typically looking at a 10-year investment horizon. So again, this is very broad comment, but generally speaking, PE buyers are looking to recognize a return to their investors in a 3 to 10 year period. Now, many can go much longer than that. But as a general rule, that's kind of their time horizon. And the third goal, this isn't a goal for family offices, but for the other players in private equity, it is you want the ability to raise future capital. And the only way you garner the ability to raise future capital is to achieve return bogeys on your fund and investment. That will allow you, with a track record, to raise additional capital. So broadly, these are the three common goals of all PE buyers. Next slide. So how does PE generate the return? Again, a very broad-based, set of answers to this, but I feel it falls into four general buckets. The first is buying right. When you look at a return on an investment, one of the largest pieces of the puzzle is what did you pay for it? So it is critically important for any buyer, for that matter, to not overpay, because I guess you could effectively overpay and still get a successful return, but boy, you just made the hill a lot steeper. So how and when you buy is critically important, and doing that right, I would argue due diligence is the single largest piece of that equation. Secondly, leverage. Using leverage, when I say wisely, because leverage can be a double-edged sword, but I believe everybody understands that if you're calculating return on investment, if you can minimize the equity investment and fund that acquisition with more debt, it increases your return, all other things equal. So there's a constant balancing act a PE firm's going to strike about how much leverage they can and want to put on a transaction. Third, growing enterprise value. By far, this is what PE is in business to do if they're doing their job correctly. How do you make the entity you acquired grow and create value for the shareholders? And we'll get into the array of ways to do this later, but that to me is probably the most important piece of generating return. And then lastly, of course, is the opposite, and that's selling right. And it's kind of the same logic applies to the buy side. Timing does matter. Obviously, if you're selling in a down market, you're going to get less. If you're selling in an up market, you're going to get more. But even more important than that is the process. And this is, what I think ties so well into the Exit Planning Institute is this: you don't put a sign in front of your company like you're selling your house. This is a time-intensive process that needs to be planned out. You need help in doing it. And these are the four buckets of how any buyer, but particularly private equity group, looks to generate return.
John, Gary Grossman has a question.
Sure.
Gary, do you want to ask your question, or do you want?
Sure. Good morning. My question is, going back to the different types of equity buyers, is there a typical size of deal that the different stratifications look at? And then from the family office specifically, do they typically plan to buy and run, or do they just invest in that? Do they bring in other operators to run it? How does that work?
Sure. Good questions. So on the first one, varies greatly, and I'm going to give a general answer to it because it's situational by buyer, by PE buyer. But generally speaking, large institutionally funded private equity groups are going to tend to look for large deployments of dollars, right? Because they have a finite fund. They have to get this money out the door, and you don't get it out the door by investing $3 million per deal. It takes just as long to do a $10 million enterprise transaction as it does to do $100 million for the most part, maybe longer. So generally speaking, that's why it's important to know the type of fund you're dealing with. If it's committed capital, they're probably going to look to do larger transactions, wanting to deploy 5 to 10 million of equity at least, if not more. Independent sponsors, much broader. Family offices, much broader. So it's fund dependent. The family office question. Could you, let me repeat that, make sure it's right. Do they look to operate it themselves or have somebody else operate it? I'd say both, but primarily the latter. So family offices have evolved immensely over the last decade from what primarily was an investment vehicle for families where they would passively invest, usually through other private equity groups or minority investments in other companies. So it was very passive. It was a diversification play. Over the last decade and a half, they've evolved massively to the point where some of them operate very much like a private equity group. They've brought operating partners in from outside the family to professionalize their office and go buy and operate companies. So again, it's situational, runs the gamut.
Thank you. Appreciate that.
Thanks for the question, Gary. Great question.
Next slide, please. So buying right, just hit on a couple things in the buying process. Of course, some are obvious. Appropriate valuation is critical. Is it going to be a platform target, or is it going to be an add-on to something else? Thorough due diligence to support the valuation you're going to put on a business, and then how do you capitalize, use leverage, and what your legal structure is. So, I mean, valuation is more art than science in my mind, because in reality, what is a company really worth at a point in time? I mean, one could argue it's worth what someone's willing to pay for it, but from a finance perspective, the enterprise value of a company is really its future cash flows discounted back present value at your weighted average cost of capital. That's the perfect valuation. And that's a model that PE buyers will go through to kind of understand what they can do with the business. The problem in using that when trying to buy a company is nobody knows what the future income stream is. It's a guess. And that's why in the marketplace, particularly in our size market here, companies tend to trade on a multiple of historic earnings. So you'll hear the term 4, 5, 6, 7, 8 times trailing 12 EBITDA, or average trailing 36, or even some combination of hard asset value. So all those indexes are a proxy for the net present value of future cash flow streams. So the only way you can really dig in, the best proxy for it is what is the company generating cash flow now? And then the PE group will look and say, how can we enhance this and grow it over time? So it's a mixed bag. Next slide. Critical importance of due diligence. And this is during a sale process where, from a business owner's perspective, you will be spending a significant amount of time, as will the buyer, digging in to really deeply understand the risks and strengths of your business to come up with appropriate or support appropriate value. And again, this is where I just can't emphasize enough to do these things up front with an outside advisor to prep for it. So due diligence is going to be deep and intensive. I just have a handful of bullet points here for things that one can expect a private equity group to dig into. And I'll quickly go through them. Happy to talk about any of them more, but quality of earnings. A quality of earnings report is always going to get done. And it's typically done by a third party where they're going to look at your financial information and it's just going to confirm that it is accurate. And this is where add backs to EBITDA or non-recurring expenses are going to be analyzed thoroughly for reasonableness. This is a critical piece of the due diligence. But if you have a good advisor up front helping you, it'll be a non-issue. Customer industry concentration, huge risk factor, particularly in small businesses. And I think it's obvious, but if you have 2 customers that are 50% of the sales, that's a huge risk factor versus 100 customers. You know, so that's just something to understand is going to be looked at hard in due diligence. What is the company's sales process, order pipeline, quoting hit rate? How do those all tie together? What is their go-to-market process? How do they quote product? How do they track their orders? How do their salespeople approach the market? The whole process is looked at thoroughly, because this is one of the common places where smaller businesses may not have a real professionalized or structured sale process in place. And to grow it, you want one. So really thoroughly vetting how they do things and where you can enhance things is important. Same applies to both costing and purchasing. What's your purchasing process? How do you cost your product? This is a huge one. Is there activity-based costing? Is it standard costing? Is it accurate? Do you understand what it's telling you necessarily? All important things to look at. Technical expertise, things like operational efficiency, your quality metrics. Do you use, standard lean practices, things of those nature? Condition of your equipment and your CapEx needs. Do you have newer equipment? Do you have older equipment? If we want to grow it, do you have the capacity to do so? Important things to understand. Real estate situation. And what I mean by that is, I'm gonna make another very broad statement, not always true, but generally speaking, a PE buyer would prefer not to buy real estate. They would prefer to lease it. And the logic behind that is there's a better use of your capital. If you have a finite amount of capital to deploy, you want to deploy it in revenue generating assets, equipment, people, technology, R&D, versus a piece of real estate that just sits there. So this is where a business owner mindset and a PE buyer might vary. But as from a business owner's perspective, I'd encourage you to be open about being a landlord and recognize that buying the real estate, which may be one of your largest assets, may not be as appealing to the PE buyer. Things like IT sophistication. Is there an ERP system in place? Does the ERP system tie in all the important facets of the business? What do your human resources process look like? Employee turnover, safety, financial reporting and budgeting. What kind of process do you have in place there? KPIs. Do you even have KPIs? And then intangible assets. I think to the extent you have trademarks or copyrights or any type of IP, that's a positive. Things like brand, legacy, maybe even a name could have some intellectual property value to them. And the last two are tough to assess in due diligence. Boy, they're critically important. Leadership depth of the management team, and what is the culture of the business? Is there an openness to change? If it's a family-owned business, will there still be family involved in post-close, and what might that look like, and all of the various factors that come into play with that? So this is a very broad and general list, but just some of the things you can expect to see a PE buyer look at in their due diligence process.
Hey, John, a question is, let's go back up to customer and or industry concentration.
Mm-hmm.
I think we've all probably read different percentages of what is probably acceptable or preferred in a transaction for not having too much concentration in either? From your guys' perspective, and as that industry moves, what do you like to see as a top percentage in either customer and or industry? Because I assume they're separate.
Yeah, and I can't answer that question honestly. It's so situational.
Mm-hmm.
It's so situational, and by nature, small companies usually have large customer concentration.
Mm-hmm.
So from the perspective of the private equity buyer, so to a business owner, that may not be a huge area of concern. They may have a deep, long relationship with their customer or a handful of customers, and they're comfortable with that. But when ownership changes, sometimes those relationships may change. And this is
Okay.
where the importance of that business owner to the entity comes into play. So I think from the PE buyer, again, sorry to say situational again, but it is. If that PE buyer has relationships with your one or two large customers and that relationship is deep,
Mm-hmm.
there's not going to be there won't be as much of a concern over the concentration. If it's an add-on investment, there won't be as much of a concern over concentration. But if
Okay.
the relationship doesn't exist, they're not familiar with the industry, then it becomes a big one. And while I can't say there's a percentage that makes sense, in the broadest sense, I would say this to the seller. When we talk about companies selling at 3.5 to 8 times EBITDA,
Mm-hmm.
if you have high concentration, you can rest assured you're going to be on the lower end of that sphere because it's just a high risk that's not easily mitigated.
Right. Yeah. So certainly if the owner is the main connection there, you've got certainly some owner dependency, but you also have some customer concentration if you're probably over 20-25% anyway, that you could take a hit from a value perspective is what you're saying.
Absolutely.
Okay, a couple questions I have for you, John, from the group is, and I know you mentioned this as you got to the bottom of this slide, is how do you assess the current state of the leadership and culture? I know you'd mentioned earlier that you think that is hard. I know we do some things from a leadership and culture perspective, but I want to get your opinion as it's like, how do you really look at that?
Yeah. So we use an array of ways and it is difficult.
Yeah.
This is one of the soft things that are difficult. So we use an array of things to try to assess this as best we can. We spend an awful amount of time with the leadership team during the due diligence process, going through various scenarios. How would you approach this? We use an outside kind of personality type test. There's an array of them out there that leadership team takes. But most of the assessment in our opinion is soft, and how much of the other factors come out of due diligence often answers that question. So to the extent you have a business that has the fundamental building blocks and processes and systems in place, and there's accountability throughout,
Mm-hmm.
you can rest assured that that means you have a pretty accountability-driven management team and leadership that's sound. To the extent there's tons of holes in these other categories, there's probably some issue there. And again, that's a really broad statement,
Yeah.
but tends to be true. So it's twofold. We use some tools, some human resource tools. And then a lot of it is, how's the business operate on a day-to-day basis? And putting those two together, we hope answers that question as best we can.
Okay, thank you. A couple other questions here for you, John. One, could you clarify if you're on the buy side or the sell side, and how much longer may it take, or how painful could it be for the seller if the due diligence isn't up to where it should be?
Okay. So was the question, am I on the buy or sell side?
Yes.
We're on both. We're on both.
Okay.
So we are an independent sponsor who buys company, grows them, and then ultimately sells them. So we take that from both sides. In regards to if due diligence doesn't come out well, I believe the question was.
Mm-hmm.
The most simple answer to that I can give is you can expect retrading in the proposed purchase price, which is why, again, if not walking away from the deal in total, depending on, where the weak spots are.
Yeah.
Which is why, again, I can emphasize it behooves the business owner to do sell-side due diligence well ahead of time using expert advisors to assist them. Not only do you avoid that pitfall, but as you go through the sale process, you can keep your eyes focused on running the business. Just because you're in the process of selling it, you still have a full-time job, right? An owner-operator, I'm assuming for the moment. But you can't take your eyes off running the business. So you need experts to help you with the other part of the process.
Mm-hmm. Another question, and similar, but I want to make sure that I ask the question. How does the smaller business with smaller structure that doesn't check all of the diligence boxes communicate the real essence of what makes the business work? For many, it isn't the large corporate model, but rather the flexibility of the smaller business.
Yeah. So that's a really good question and a tough one, and I'm going to give a general answer to it. For the very small business that doesn't check a lot of the boxes, let's be very clear. There's nothing wrong with that equation to the right buyer. Mm-hmm. Just like there's nothing wrong with that equation to the current owner operator. Many owner operators start their business from scratch because they're excellent at one or two things and they grow it organically from that. And they're their own boss. They run their own ship. They do things very well. But that could be deemed what you often hear a lifestyle business. And there's absolutely nothing wrong with that. You have an income, you employ people, the business provides good product and services. But that type of business is quite different from one that has created vast enterprise value or equity value for that owner that's going to be recognized by a buyer who wants to take it to the next level.
Yeah.
So I guess the short answer is that, again, on this, range of 3.5 to 8 or whatever times EBITDA, if you're small and you don't check a lot of the boxes, you just need to recognize that the value of the business is probably on the lower end of that sphere. Unless you find a buyer who finds what the uniqueness you bring to the table very complementary to a holding they already have. Then there could be mass value there. But there's a flip side to that, right? The flip side may be, we don't need all your employees. We already have capacity. We may not need your facility. We want your customer list. We want your technical expertise. We want your salespeople, your market knowledge, but we don't need a lot of your overhead. So that what to do in that situation is owner dependent. Is that acceptable or isn't? And there's no right or wrong answer to it. But from a pure value perspective, you're just worth less. And again, there's nothing negative with that.
Yeah. Yeah. We had a comment I want to share with everybody. If they're not by chance looking at the chat, the group chat, is it's important for the seller to be transparent before and during due diligence, and due diligence should be confirmatory, not discovery. So just a comment that was put out there.
Don't disagree with that.
Yeah.
I think I will make a comment on that. I think that probably is largely dependent on the sophistication of the seller and their advisor. I would say it's much more that way if they have a really good advisor assisting them.
Yeah.
If not, it becomes much more discovery because those things aren't put out at front for buyers to see necessarily. Everybody wins. Everybody wins when there's great transparency in that, in my opinion.
Right. And the question is, can the investment in the sell side due diligence be capitalized somehow?
You mean from the buyer's perspective?
Gary, you want to?
No, the sell side. So in other words, if they're investing in improving their systems, improving their processes, basically getting everything, the fundamentals that are being purchased in better condition, is there a way to, if they invest in somehow, some way to help get somebody to help them fix that, can they even their KPIs and such, is there a way to capitalize that so that they don't feel like it's an expense, it's an investment? Is there a way to do that? Or what's the return on that if it's better than worse?
All right, so if you're asking an accounting question, I would defer to an accountant as to whether you can capitalize any of those costs. It's probably more of a gap thing. But does it enhance the value of your business? The answer is definitely yes. So a buyer is going to look at that. A buyer is going to, particularly a PE buyer, is going to come in and they're going to say, we want to grow this business. In order to grow this business, these systems, processes, CapEx, capacity need to be in place. To the extent they already are, they will pay more to that seller. To the extent they aren't, they will pay less because they'll have to make the investment post-close. Does that make sense?
Mhm.
Yeah, that's perfect. Thank you very much. I appreciate that.
Good questions. Thank you.
Yeah, I wanted to go back and another point that was made on the culture and leadership. I want to repeat this just in case some of the folks were not looking at the group chat. As someone that has designed and facilitated leadership development for over 20 years, they would recommend evaluating these items: business process knowledge, which is part of the due diligence process; emotional intelligence, which is independent of the culture and the product, and also taking a look at leadership competencies and what are the 5 critical behaviors to maximize returns in human capital. And lastly, the capacity to think complexity. Can the leadership team operate in volatile, complex, uncertain, and ambiguous context? All of these items can be evidence based on how you evaluate them. Yeah.
Great feedback.
Yeah. Great comments and great questions. Thanks. Yep.
Let's go through to the next slide quick.
Yep. Yeah, you're getting some questions on the COVID-19, so I know that you're going to touch on that a little bit, John, when you get to the back.
Sure. I'll try to finish these up really quickly.
Certainly.
We can get to what we want to discuss. So I'll just hit on leverage real quick. And the reason I bring this up, one may ask, why should a seller care how the buyer capitalizes a transaction? I would argue you really want to know for a couple reasons. So I'll just give you, again, a very broad example. Let's say a company is going to trade for 5 times trailing 12 months EBITDA. That's the purchase price. Well, how is the PE buyer going to fund that? I mean, this is broad, but generally speaking, in the smaller end of the middle market, you can go to a bank and get 2 turns of senior debt. That leaves 3 turns that needs to be funded by some other source. If you're funding 3 of the 5 turns with equity, that's likely not a really good return on investment equation, right? So the PE buyer has a decision to make. If there's enough cash flow and the market allows, maybe you can go out and find a mezzanine provider that provides 1 turn, and then you only have to put 2 turns of equity in. That math makes a lot more sense. But if the market doesn't allow for that, how do you fill that gap? Well, you fill it one of 2 ways. Either reduce purchase price, or you say to seller, will you provide some seller financing to fill this gap so that I can keep the so I can keep the purchase price where you want it to be. So I would argue the seller really needs to understand how a PE buyer is looking to capitalize it, to understand how they're looking at value. And the other piece is, to the extent they want you involved or rolling over equity, you want to understand how they're financing things, because you're part of that entity now. You have a real stake in it on an ongoing basis. Those don't want to comment on leverage. Next slide. I just highlighted, we'll step back for a minute. So in growing enterprise value, what are you really looking to do? I like to simplify things, but the overriding goal from the PE perspective is you want to minimize the risk factors in the business while simultaneously maximizing cash flow, which seems obvious and reasonable, but how do you do that? And this list of things are general things that a PE group is going to look to put in place to the extent it isn't. So you're always going to see some semblance of a 100-day plan to guide the management team through the transition of ownership. And while the playbook is pretty standard, putting fundamental business building blocks and processes and systems in place that the company just acquired to the extent they didn't already exist, a lot of what needs to be done is identified in the due diligence process, kind of the gaps that are missing that would prohibit the business from maximizing its enterprise value. So these list of things are just some of the things that a buyer is going to be focusing on early in the investment to get put into place. Next slide. And the last was exiting. Timing matters from the PE buyer, and then to any sort of seller, again, perform sell-side due diligence, and engage in M&A advisory firm to leverage their expertise and help. And I'm of the contention that business owners should operate their business like it's for sale every day. And if you are, you tend to be putting in place best practices. Next slide. So this is just, I think, kind of a summary of the things we've already somewhat hit on, but the purpose of this presentation was to show value enhancers or detractors to value in the eyes of the PE buyer. And all of these bullet points are really true, tangible value enhancers. Is there strong and deep leadership? Is there a clearly defined competitive advantage? Most business owners will say they have one, but it's often tough to define, and often one doesn't really exist. So being able to clearly define that's important. An aligned and robust marketing, sales, costing, quoting infrastructure. In a lot of businesses, these are operated in silos or different buckets. They have to operate together to maximize enterprise value. Operational expertise, plant floor efficiency, quality and safety, all the various metrics and measurements that you put in place. Sound IT infrastructure, systems connecting and giving you real-time data to make decisions on is critically important. What's your capacity situation and what's the diversity of your customer base? These are just a handful of the big things that, to the extent they exist in a company that's for sale, you will drive enterprise value versus detract from it. So with that, I'm happy to hit on anything that I may have missed or was unclear on, or any other topics we'd like to discuss.
Yeah, for right now, go ahead and open it up with some questions, but there are some questions that are coming through. John, do you want to speak now, since the environment has changed with COVID-19? Is there anything that you would like to speak to of how that has impacted the way you guys or other PE groups will start looking at businesses?
Sure. I can tell you from our perspective, and I think that I'm assuming most private equity would say the same thing here. By necessity, right, our focus has turned inward even more than it normally would. Right, we were in a unprecedented period of time where, for all intents and purposes, the economy is effectively shut off. Right, so it's been crisis management at different levels for each of our portfolio companies, and so we've turned our attention inward and focused on certain fundamentals, things like driving decision-making based on 13-week cash flow, reducing costs to a bare minimum and CapEx, putting first and foremost the safety of our employees. The very first thing we did was institute CDC recommended social distancing, putting cleaning stations throughout. It's vastly changed the way we've done things, but it's been crisis management driven by business fundamentals that anyone would employ. So by nature, that takes more time. So less time has been spent looking at new investments, but we haven't shut that off completely. And I think, and I would imagine most PE buyers would say the same thing. And I do think that whenever there is a market dislocation that happens, that often opens up, the flip side of that is it opens up opportunity to make really smart investments. So we're certainly looking for those that make sense, but there is less time being spent on that side of the business.
Mhm. Okay. What are, in the due diligence process, where do you find the biggest gaps?
Again, very situational, right? Um, I'll come at this question from our perspective. So we are a buyer of, I would deem, smaller businesses, and roughly defined as, less than 50 million in revenue. So often, and the further you go down the revenue scale, by nature, certain things tend to be lacking in a business. It's just natural. The sales process we often find is less than structured, it's often word of mouth or one or two people that have developed relationships over time versus having a go-to-market strategy with measurements that ties in multiple facets of the business, which goes back to one of the things we talked about earlier. Is your marketing department, is your sales team? I mean, some small companies don't even have both of those. One may be both. Is your costing, is your quoting all aligned together? Or are they separate and distinct? So that is a costing of product, accurate costing of product that helps drive how you quote and where you make your money, and how you go to market are two things that are very frequently lacking in the type of companies size-wise that we're looking to acquire. So that stands out probably the most. We get all kinds of quality of earnings issues that come up, but those are easy to fix, but those are typically in situations where they haven't engaged an advisor to help them up front with that. And to the extent they haven't, you'll find more gaps in the quality of earnings analysis. So I guess those are the two things that stand out.
Okay. With the pandemic situation, have any of the value enhancers changed either in priority or the way that you would add them or not?
I would say no. In fact, I would emphasize getting back to the basics, which is always what's done in crisis management. I would say that, again, minimizing risk while maximizing your cash flow or liquidity position is highest priority.
Mm-hmm.
So utilizing the tools that allow you to do that in times of crisis like now, I think, is critical. So everything needs to be driven around, because it's not only are we in an uncertain time, it's one of uncertain duration. So we don't know how long this is going to last or how it comes back. So you have to maximize liquidity. And, one piece of that obviously is 13-week cash flow and living and breathing by that to help drive your decision-making process. Communicating with all of your constituents, your employees, your lenders, your customers, your vendors, your landlords. You have to be open, transparent, and communicating constantly, because we're all in this together. So just as we may be negotiating extensions on, paying our vendors later than normal, on the flip side, our customers are doing the same thing. So you got to communicate with everybody openly and transparent and recognize everybody's generally in the same boat. You want to be moving in the same direction. The other thing that's interesting right now is the governmental funding that's out there. I think people may have differing opinions on it, but I would contend that if you are not thoroughly analyzing that and procuring it as appropriate, you're not doing your fiduciary duty as an owner or a GP to the extent you can. Now, there's circumstances that I would say that those programs don't fit for any given business. But generally speaking, in the small business community, you need to be taking a close look at that and procuring it, in my opinion.
Yeah.
Because it gives you liquidity runway during an uncertain period.
Right.
It's immaterial to me whether it's forgiven or whether it becomes a loan. This is about maximizing liquidity, which is in every business constituent's best interest.
All right. Do we have any other questions anybody would like to unmute and ask the question, or send it through the group chat? Okay. Doesn't look like we have any more. If they do, they can either unmute and ask the question or send it through the group chat. I think we have another polling question. Is that correct, Lisa?
Yes.
So do we have that polling question up?
No. You're logged in from another device. Give me just a minute. Why don't you talk about that while I'm doing this?
Okay, so we've got some other events coming up in May. May 26th, we have expense reduction in companies with Paul Zielinski and Marty Leiter. So they'll be talking about how to reduce expenses inside of companies. And then in June, we have leveraging the SBA loans and as an exit strategy with Mark Davis from First Business Bank. Our July is always defined as a social gathering. Right now, it's certainly scheduled for Big E's in Grand Rapids downtown. My guess is we probably won't be able to gather with that many people by July, but hopefully we can. If not, we're going to send out an invite anyway, and would like to do a virtual kind of social gathering / happy hour. So we'll make sure that everybody gets that information so that they can participate if they have the time and would like to join on. So if you want to go to the next slide, Lisa. So again, we do have our own website here, EPI West Michigan chapter. If you want to get a view of what the other programs are, meetings that we have throughout the course of this year, and find out a little bit more about us, we certainly have some information on our website. And then also we have some social media with Facebook and also with LinkedIn. So if you'd like to follow us on LinkedIn and on Facebook, we also have a page out there. So again, I want to encourage you that we are trying to put some additional information out there for everybody. And if you are interested in writing an article that would be put on our LinkedIn page and our Facebook page, please send us an email and we'd be happy to work out and get that information posted out there for you. So Lisa, were we able to get the survey up?
Vincent, you might want to check on your end to see if you have access to the polling.
All righty.
You mind
No.
if I ask a couple of questions?
Yeah, go right ahead, Gary. So go right ahead.
Okay. So Chris, Martha asked a question. How often are you seeing sellers perform seller due diligence prior to going to market? Was Martha's question. And then I had another question below, but I'm curious the answer to that.
Yeah, my perspective on that is to the extent they have engaged, good M&A advisory services, that's typically been done. To the extent they haven't, it hasn't. So, we don't always know. I can't give you a complete, we don't always know the amount of sell-side due diligence that has been done. Now, I can extrapolate by the way they communicate and the information that's provided, whether they have or not. And again, I would say when there is a partner engaged to help the business, I would say typically some semblance of that has been done. When there is not one, usually none has been done, and it becomes pretty quickly apparent. So I don't have a percentage.
Gary, did you have another question?
I did, but Martha had a follow-up question.
He does?
Yeah, she was saying, she was asking, how does the change the amount of due diligence that the buy side does, that the seller has done their due diligence? In
Yeah,
other
so
words,
well, yeah, so it does. Okay, so let me comment on that. So maybe I can expand. Oftentimes, we will get, as part of the due diligence, their quality of earnings report. Okay, oftentimes we'll get that from the M&A advisor. So clearly some has been done. Doesn't mean we don't do our own. In some way, it might be abbreviated in some way. But you find out very quickly how much has been done based on the timeliness of the information when you ask for it and the thoroughness of it. So it's pretty clear up front. And to the extent these fundamental things are covered, it vastly hastens the process. It moves it ahead quicker.
And then going back, my question was, in this COVID times, when you're evaluating expense reduction, cash flows and all that stuff, obviously everybody's cutting expenses. My question is, for your portfolio companies that you already have, how do you help them evaluate expense reduction in a way that's not reactionary? So in other words, they're cutting dollars without, really thinking about the value that may be in what they're cutting. Like they may cut people, they may cut whatever, but how do you help them with a validated expense management versus a reactionary expense management?
And I wouldn't say that that's specific to the circumstance we find ourselves in right now, right? I mean, we do that on an ongoing basis. So I think that's just part of a budgeting process and value proposition decision matrix that we go through in the normal course. So that, from our perspective, is not that big of a change.
Right.
But I'll give you just some basic examples of what we deem non-essential. We've cut our management fees down to completely off for a period of time, first and foremost. Okay, that's one. Obviously, travel and trade shows and all that stuff is off. But the big one, and this is where the governmental funding comes in place right now, if appropriate, is we have different level. Our three businesses have been affected in different ways, from, I wouldn't say business as usual, but a relatively strong order book, to one operating at about 50% of volume and one completely shut down. All right. So from an essential, I can tell you that what we would have done immediately, as most business owners would be immediately lay people off, to the extent we didn't have work for them to perform. But we have not had to do that because of another source of funding. So when you look at essential expenses, that's one that would have happened absent another mechanism for funding it.
Makes sense.
Okay.
Any other questions? Okay, well, I know that we've done these enough. Certainly, with the size of the group and the amount of people working at home, we're having a little bit of technical difficulty. So, unfortunately, I don't think we'll be able to get the last polling question up there. So we do apologize for that. Lisa, could you go to the next slide? Again, I had mentioned earlier, if you have any articles that you would like publicized on our social media for owners and community that would help owners read, advisors, or whatnot, educate, please let us know. We'd be happy to go through and talk to you about what the content needs to look like and whatnot, and post that out there for you. So we went through a previous other meetings that we have coming up, both in May, June, and July. John, we want to thank you for coming on today. Really appreciate all of the information. Feel it is extremely valuable. We understand, certainly with the current environment, it certainly can change quite rapidly, and understand that each business is kind of its own view and how that looks. But certainly the outline of what you have here, I think, will really help everybody that was on, and I want to thank everybody for booting on. I want to thank the people that really also booted on from out of state. I'd like to thank Martha Sullivan, who is part of the EPI West Michigan chapter in Milwaukee, Wisconsin, and heads that up over there. So Martha, thanks for being on with us this morning, and everybody else. So if there are no other questions, thanks again for everybody. We will be sending out a recording of this session here probably later on today. So you will get that in your email and you can save that and view it again. If you have any questions or comments in the meantime, feel free to go ahead and email that over to us, and we'll make sure that we answer your question as soon as possible. So again, John, thanks. Everybody, thanks for your participation, and have a great day and an awesome week. Stay safe.
Thank you.
Thank you.